Welcome. Thank you so much for joining us today in this Financial Institutions podcast. This podcast is part of our Lenders series, where we tap into the breadth of knowledge and services across various departments and practice areas at BerryDunn, really just to have a conversation with individuals that specialize in certain areas across the firm and really bring those to bear for current and emerging topics that may affect lending. And my name is Susan Weber, a 26-year banker with a focus on credit and credit risk. And co-hosting with me today is BerryDunn's Financial Services Practice Leader, Principal Rob Smalley. Hi, Rob.
Hi, happy to be here. Happy to be co-hosting, particularly for this guest, Ryan Gough, principal in our non-for-profit practice, expert in everything non-for-profit. For those familiar with the Gallup employee engagement poll, he is my best friend at work. So I'm just excited to have him. Nearly 2 decades within the firm, just absolute expert when we're talking about nonprofit area. And Ryan, what have I missed?
Yeah, no, 2 decades, pretty close. Coming up on 19 years, been with BerryDunn, primarily focused in the not-for-profit practice group, focusing on affordable housing, mental health agencies, developmental disability organizations, colleges, universities. Pretty much if it's a nonprofit, I've worked on it and love it. It's very mission-focused organizations and very much take pride in those clients and their mission-driven focus.
So you talked about a number of different types of organizations. The nonprofit space itself is an area that can be tricky because there's just more traditional ways of sort of seeing and understanding financial statements, like in the commercial realm. But these can be a lot different than that. Do you have any thoughts on, particularly focus on sort of the lenders? Thinking about those. Our podcast is mainly aimed at those. But what's different? What should they pay attention to?
Yeah, there's a lot of things with not-for-profit financial statements that can be different, confusing, especially if you're not used to actually seeing a set of not-for-profit financial statements. There are different, requirements under U.S. generally accepted accounting principles and how not-for-profits report versus for-profit organizations. And I mentioned the financial institutions. And so there can be challenges with certain things like donor restrictions and other funding sources that could have impact on how operations are reported, how they could impact their general observations, what's available to be used, which can also impact how banking institutions could be considered with debt covenants and whether or not those organizations can meet those covenants. And so it's really important to have that basic understanding and that knowledge of how to read a set of financial statements, not-for-profit set of financial statements, understanding the nuances between for-profit and not-for-profit, so that lending institutions and other organizations, other individuals, users of those financial statements can actually understand how it could potentially impact certain things like debt service coverage ratios or other covenants.
So you mentioned, Ryan, just a quick follow-up, you mentioned donor restrictions as one example. It kind of comes to mind. I think about the mix of income sources that not-for-profits typically have. Maybe give us a quick example. How might that donor restriction play out from a lender perspective?
So, if a donor were to provide a substantial donation or just a donation in general that is restricted to a particular purpose related to a program of an organization, I think an easy example would be with a higher education institution with a certain particular restriction on a scholarship donation, what type of student the scholarship can actually go to. And so generally what will happen is those dollars will come in one particular year, but until you have that qualifying expenditure, that qualifying individual where you can release it and use it to cover the expense itself, can impact how you would recognize or see how that donation is going to impact the operations of the organization.
So must be kind of tricky when it comes to really quantifying cash flow.
It can be. It absolutely can be. And there's a lot of, again, with that nuance type thing, there's a lot of misunderstanding, if you will, when it comes to when something should be restricted versus when a restriction is no longer. We've had in the not-for-profit practice group, and in particularly with some of my clients, have had some interesting conversations about how certain things should be reported once those restrictions have been lifted, because in a lot of cases, organizations will still want to use some of those dollars for future budgeting purposes. Mm-hmm. But from a donor perspective, the restriction no longer exists. So can these dollars be reported in another manner? And the answer generally is yes, as long as you're following the guidelines and staying within the requirements of U.S. generally accepted accounting principles. And so I've had a number of recommendations, conversations with clients about how to do things a little differently, and so far they've panned out and working in the manner in which the client was looking to achieve.
That's really great. And I'm thinking now about maybe some of those other ways in which these conversations are even more convoluted or confusing today. And I'm thinking COVID, right? I can't not think COVID. And I feel like we're in that coming out time now, right? We're coming out of the COVID era. So if we're thinking about that and non-for-profits, are you seeing anything there that we ought to be aware of in the lending space?
Yeah, and it's going to be a case-by-case basis, because certain organizations are reporting things in ways that maybe others are not. Mm-hmm. Now, in a lot of cases, there will be additional disclosure in the notes to identify some of this funding. But yeah, Susan, you're absolutely right. We're pulling out of a pandemic time, kind of moving into more of an endemic situation, and a lot of the funding that the feds, the states have provided to organizations to help keep them afloat, to retain, to recruit employees, because resources like employees are really scarce right now, and you got to pay them and got to protect them too. And so what we've been seeing is a lot of organizations who have been receiving a lot of COVID-related funding may have reported it in a manner that is included just with their grants revenue line or contributions, and doesn't really specifically pull it out and report it separately to allow for organizations, banks, other users of the financial statements, and understanding of how this COVID funding has really impacted their operations. And I've been having conversations with boards and other clients about, how do you pivot, or what the plan is about when this money dries up, because it's drying up. Yeah. And so have you looked forward, forecasting, which we have helped with our clients on forecasting operational, how this is going to impact their organization once this revenue stream dries up, to make sure that they're making the necessary adjustments so that moving forward, you're not holding a massive amount of expenses that you've incurred because of the COVID funding that you've received and haven't had a chance to understand how it's going to impact you moving forward. So, we've worked with our clients talking about how that looks, helping them with forecasting models and other things like that. And I think the response has been great, keeping in mind that there is going to be some hard times coming forward. I think there's a lot of organizations that haven't had the ability to understand the impact and making sure that they have the necessary resources to help with that. And that's where I think sometimes BerryDunn can help out.
Yeah, thinking about, Ryan, the way that we started this conversation, these organizations, they have great missions. A lot of them can be great credits for community banking, for the community banking folks. What have we done? What can we do to sort of help the lending community, to be able to lend to these folks confidently?
So one thing that we've done in the past, and I mentioned the forecasting models helping out at least the not-for-profit institutions, and but from a education standpoint, understanding how to read a set of not-for-profit financial statements, what you should be looking for, helping with board education. We've done, I can't even tell you, countless number of presentations to lending institutions. A lot of times bankers are the ones that are sitting on the boards, and just making sure that everyone is understanding the financial statements themselves, what they mean, how COVID is going to impact, and this is a conversation that has long since happened, but with the new lease standard too, like how the lease standard could be impacting individuals' debt service coverage ratios or other covenants that have been set forth in the loan documents. And so working with those lending institutions, those bankers to understand how those impacts or how those financial statements can be impacted with these types of changes.
That's so good to hear. Financial statements are getting more and more complex. The COVID funding is just, added another layer on top of that complexity, and to have folks like you, experts in the field, ready to go, ready to help folks is amazing. Certainly, if we've got lenders out there that want to, have a little bit of an education, particularly at this time where you've got leases in play, and then ultimately CECL for nonprofits is going to be in play for some of them too, which is a little bit different. Certainly reach out to us, and certainly reach out to Ryan Gough. Susan, any summary comments on today's podcast?
Well, this was really great. It was actually one of the first times I got to meet Ryan. So this was a wealth of knowledge. I know exactly who to call now when I have a question on not-for-profit. So thank you so much, Ryan, for your time. And thank you, as always, Rob, for co-hosting with me. We'll provide a link to Ryan's contact information and those resources in the podcast description. Thank you to our listeners for tuning in today. Always interesting to dive deeper into an industry you may be lending into. A quick reminder that today's podcast is part of our Lender series, where we're focusing on these topics, trends, and industries to help give you the edge, and hope you'll join us next time. Until then, happy lending.